As a part of the financial planning process, pro forma financials are going to have to be developed for the business. Now, the expression pro forma is Latin and it means in the form of. So in building pro forma financial statements, what we're doing is taking the format of a balance sheet and the format of an income statement. We're putting expected information into it. We're putting our forecasts into this format so that we can better analyze it and discuss it. This is a part of the financial planning and analysis process, the FP&A process, that drives our capital expense management, it drives our operating plan, it drives our cash budget, and it drives all of the other processes. But it also gives an opportunity to analyze the cash flows of the firm. Because profit is the foundation of cash flows, we're going to start off with the pro forma income statement, and we'll make a forecast around what's driving the operation forward. The pro forma income statement is going to be based, first of all, on some sort of an estimate of upcoming sales, and then the upcoming expenses that are related to those sales. Because the assets are necessary to support the operations, we'll then forecast what's going to appear on the balance sheet and build a pro forma balance sheet. Pro forma financials are always based on some sort of past performance and then adjusted for the expectations that we have. So typically the start point for understanding a pro forma financial statement is going to be to look at a common size financial statement from the past. A common size income statement, for example, would give us an idea of how revenues and expenses relate to one another. A common size balance sheet is going to give us an idea of what the composition of assets is. Above and beyond that, we'll have some sort of a forecast of the top line of the income statement. So we'll have a sales forecast that's probably going to come from the marketing department, possibly adjusted for economic expectations. Based on the volume that we're going to see coming through our organization for sales, this gives us an idea of what sort of capacity of assets is needed, so we can analyze the capacity of the company and determine, is there some sort of a capital expenditure that needs to be made, and build that into our CapEx budget, which ties back to the long-term strategic plan that the company is operating under. In order to prepare a pro forma income statement, we need to start with the top line, the revenue line. This is typically going to be some sort of a function of volume and price per unit. If we know the expected volume that we're going to sell based on marketing projections, and we know the price per unit, we can come up with what that top line is, and then from there we can make estimates of other things. The most accurate way to start to estimate our direct costs is going to be to take the volume sold times the variable cost per unit and estimate our total variable costs. This makes the assumption, of course, that we understand what the variable costs are within the company. If you're an outsider trying to make some sort of an estimate of a company that you're analyzing for investment purposes, you probably won't have access to that information. So as an alternative, the other way is to look at the cost of goods sold as a percent of sales by looking at a common size income statement from the past. By looking at COGS as a percent of sales, we're able to tell what should this be based on the dollars in revenue that we're expecting in any particular year upcoming. Other costs will typically be estimated using the percent of sales method, again using the common size income statement as a basis for that. And the trouble with using such a simplistic approach is that not everything grows at the same rate as sales. Depreciation is a good example of this. Depreciation is going to be much more closely related to the investment in assets that's required by the sales volume that we're expecting. So as a result of this, we'll use percent of sales as a start point, but we may have to make a few minor adjustments to it where it makes sense. Preparing a pro forma balance sheet, there are really three approaches that we can take. The most simple method is going to be to use the percent of sales method. Now, note that I said percent of sales and not percent of assets. We're not basing this on the common size balance sheet. Rather, we're going to look at each one of the assets as some sort of a function of the sales volume in the past. For example, if we know that we need 3% of our annual sales on hand in cash, if we're forecasting the cash line, it would be the expected sales for the year times 3%. This isn't going to be accurate necessarily for all items. Property, plant, and equipment, for instance, is going to be driven much more by capacity than by a sales volume. If we're basing the property, plant, and equipment as some sort of a percent of sales method, we're making the assumption that the operation is scalable on a very, very small level, and that's simply not true for most capital investments. A more accurate approach is something called the judgmental approach. In this approach, we're going to take an estimate of specific line items. So we would recognize, what do we expect our property, plant, and equipment to be? What sort of limitations do we have around cash? What sort of expectations do we have around the inventory that's necessary? And we'll determine, is there some sort of an imbalance in our balance sheet? If the assets do not equal the liabilities plus shareholders' equity, we know what the gap is going to be, and we're simply going to plug that gap with some sort of external funds that the company is expected to bring in. The company is either going to borrow money or bring in equity investment from somewhere. Now, the external funds figure is frequently abbreviated with EFR or EFN or AFR or EFN, standing for extra funds required or extra funds needed or additional funds required or additional funds needed. The formulas that exist for this are things that finance majors will get into later classes. But the important thing that you need to know is that it's simply by what amount is the balance sheet out of balance. And then there should be some sort of logic behind where is this fund going to come from. In most cases, we can make the assumption that the capital structure of the company is reasonably stable, and we're going to stick with that same capital structure moving forward. So if they have a particular debt-to-equity ratio, we would expect a certain amount of that extra funds needed to come from debt and a certain amount of it to come from equity. So we use a little bit of our ratio analysis as part of the driving force between determining what that plug number is going to be. The third approach is a little bit of a departure from this. This is something the textbook doesn't cover, but I find is sometimes useful for trying to estimate what a balance sheet is going to look like. The total asset turnover suggests what total assets should be based on a volume of sales. Since the total asset turnover is sales divided by total assets, we can figure out what the total assets are that we'd forecast for a company by taking sales and dividing it by the expected total asset turnover. For instance, if we know that the total asset turnover is always 4.0 and sales are anticipated to be $100 million, $100 million divided by 4 is $25 million. That would be the total assets that I would expect for the year that I'm forecasting. Knowing that that $25 million in assets has been forecasted, I can then assign the values based on a common-sized balance sheet. So if I know that cash is always 5% of total assets, I'm going to take 5% of that $25 million and I'm going to produce that for my cash number. I do the same thing for each of the other line items in the assets, the liabilities, and the equity section. And I'm going to look at how stable this common-sized balance sheet has been over the past years. What I'm looking for, if I'm going to use the total asset turnover method, is some sort of stability. Is the company actively managing their balance sheet to maintain the same composition of assets and composition of liabilities? From this, I'm still going to make some sort of adjustment based on, for example, the expected contribution to retained earnings and the expected dividend payouts that are going to come in. And so it comes back eventually to being a variation on the judgmental approach. I'm just starting with a slightly different start point. When we're evaluating pro forma financials, we need to recognize that none of the forecasts that we make are certain. What we're trying to do is come up with an expectation of what the future is going to be so that we can plan ahead. And then we're going to adjust those plans based on either exposed circumstances or some sort of a regular schedule. First thing you want to do in evaluating pro forma financials, of course, is going to be to check the arithmetic, making sure that all of the columns are added and subtracted appropriately, that the growth rates have been applied appropriately, and that all of the internal logic around your financials holds true. In other words, are you predicting that assets are going to grow at a certain rate for different categories of assets? Are your fixed assets growing at one particular rate or as a function of something as compared to your current assets, which are much more likely to grow as a percent of sales? You're going to want to analyze a set of pro forma financials using the same things that we used in financial statement analysis. You will look at common-sized financials in order to do some sort of vertical analysis. Is the composition of the income statement and the balance sheet correct? You want to look at the rate of growth of line items, so you do some sort of horizontal analysis. If you find that the sales have grown at a regular rate of 2.3% over the last 5 years, and all of a sudden marketing is predicting an 8% growth in sales, that suggests that maybe we need to revisit that line item. Similarly, if we find that our cost of goods sold has grown at a rate of 5% per year and it suddenly drops down to a 1% growth per year, that again is something we want to look into. So we're looking for some sort of exception that we'll dig into. On top of that, we might compute the answers to certain key ratios, things that we really want to know the answers to. Not just the return on equity and seeing how that works out, but specific things like our asset turnover ratio and our accounts receivable turnover period and our accounts payable period. Specific questions that we want to analyze in order to determine, is this company going to continue performing the way that it has in the past and in accordance with what we expect? And then finally, I'm going to examine the cash flows of the company compared to history. I'll examine both the operating cash flow and the free cash flow that's generated by the firm and make sure that this seems to hold up to what history suggests that it should. Based on this, it's possible to take the pro forma financials from a whole company and value those the same way that you would a capital project. What you do is take the free cash flows generated by the firm on your pro forma financials, determine what the expected growth is going to be of those free cash flows beyond your forecast period, and come up with a terminal value based on that. Treat those as a perpetuity and discount that back to whatever your last year is going to be. Treat that as a terminal value just like you did in your capital budgeting process, and then discount the cash flows according to the weighted average cost of capital of the firm. And this should give you the value of the overall company. Removing the value of the debt from the company is going to leave you with the value of the equity, which is really going to be the basis of what you would expect the shareholders to be paying for this company on a moving forward basis. This is kind of the fundamental thought that leads the finance majors into courses like Finance 449, the valuation course, and should be the beginnings of understanding fundamental analysis of securities, which is going to be a part of what we study as a part of investment management. For this class, all that we need to know is how to build the pro forma financial statements and what to do with them when we're done.